Picture this. You're at a poker table, but you've got a secret. The cards are marked and only you know what's coming. Every bet you make is a guaranteed win. Sounds like a dream, right? Except it's not a game. It's the stock market, and that's called insider trading. From corporate crooks to Congress members dodging the law, let's explore the biggest cheats, the sneakiest tricks, and why this crime threatens to burn down the market. What is insider trading? It's when someone uses secret company information to make money on stocks. This secret info isn't available to the public, so they have an unfair advantage over everyone else. Not all secrets count. The info has to be material. That means if regular investors knew this info, it would change how much they want to buy or sell a stock. For example, knowing a company will report huge profits next week? Material. A pharmaceutical company discovers its new drug, fails clinical trials? Material. A tech firm lands a massive government contract worth billions? Also material. All of that could move the stock price dramatically once it goes public. Imagine your friend works at Big Tech Co. They tell you the company is about to announce record-breaking earnings tomorrow, something no one else knows yet. If you rush to buy shares today, before the news breaks and prices shoot up, that's insider trading. You're using secret company info for personal gain. So an insider is not only just the CEO or CFO, it could be anyone with access to secret info. Corporate executives, regular employees, shareholders with big stakes, and family and friends of insiders can become guilty by association if they act on tipped-off info. Think of insider trading like playing poker with marked cards. Everyone else thinks the game is fair, but you know exactly which hands will win. Would anyone play with you again if they found out? Markets work the same way. Trust collapses when people cheat. Cheaters don't always trade directly. Sometimes they tip off buddies, family, or brokers to do the dirty work. Other times they set up shell companies or offshore accounts to hide their tracks. But regulators are smart. They follow the money trail. Insider trading fines in the USA can reach up to $5 million for individuals and $25 million for entities, with prison terms up to 20 years for individuals. There is legal insider trading when executives and employees trade their own company's stock, but only after following strict rules. They must report these trades publicly, and they can only do it during specific windows when no sensitive info is pending. Why it matters? Insider trading wrecks trust in the stock market. If the game feels rigged, regular investors pull out. That hurts everyone. It also screws over ordinary people who lose money when insiders cash in unfairly. Companies caught in scandals often tank, think layoffs, stock crashes, or even bankruptcy. Ethically, it's a gut punch. Why should a few cheat while everyone else plays fair? Look at Enron. Insider trading was part of its collapse. The stock plummeted, employees lost pensions, and trust in markets took years to recover. Fairness keeps the system running. Insider trading burns it down. Biggest insider trading scandals. Ivan Boesky, 1980s. A high-flying arbitrageur in the 1980s. Think Gordon Gekko's real-life inspiration, the original Wall Street villain. Boesky paid corporate insiders for tips about upcoming mergers and acquisitions. Armed with this info, he made millions betting on stocks before deals were announced. Caught red-handed, Boesky cooperated with investigators to take down bigger fish, like Michael Milken. He paid $100 million in fines and served 3.5 years in prison. Boesky famously said, "Greed is all right," in a speech, a sentiment later echoed by Michael Douglas's as
Greed, for lack of a better word, is good.
In the film Wall Street. Unfortunately for him, Boesky's greed led to his imprisonment. Martha Stewart, 2001. Yes, the lifestyle icon. In 2001, she sold shares of a biotech company called ImClone right before the stock crashed. She claimed she had a preset plan. That was a lie. The tip came from her broker who knew the company's drug had just been rejected by regulators. She didn't go down for insider trading itself, but for lying to investigators. Result, 5 months in prison, plus home confinement and a destroyed reputation. Fun fact, the amount she saved? Around $45,000. She lost millions more in brand value. Raj Rajaratnam, Galleon Group, 2000s. Biggest insider trading bust in U.S. history at the time. This was industrial-scale insider trading. Raj ran a hedge fund and built a network of corporate insiders feeding him tips. Tech companies, Wall Street banks, you name it. He made over $90 million from inside information. Phones were tapped. Wiretaps caught Rajaratnam bragging about his schemes. The FBI had him dead to rights. In 2011, he was sentenced to 11 years in prison, fined $92.8 million, and ordered to repay $53.8 million. Last but not least, unconfirmed, allegedly President Donald Trump and associates. On April 9, 2025, Trump posted, "This is a great time to buy," on Truth Social, hours before pausing tariffs on most countries, causing a 9.5% S&P 500 surge. His company's stock, DJT, jumped 22%, netting him an estimated $415 million in one day. Suspicious options trades 10 minutes before the announcement yielded $30 million in profits, suggesting someone knew the pause was coming. No convictions yet. Democrats like Senator Adam Schiff are pushing for SEC investigations into possible insider trading or market manipulation. Penalties could include up to 7 years in prison and $5 million in fines per violation if proven. Trump's post used his initials DJT, also his company's ticker, raising eyebrows. He later boasted in the Oval Office about friends making $2.5 billion and $900 million that day, fueling speculation of tipped-off insiders. How inside traders avoid detection? Insider traders are sneaky. They know the SEC is watching, so they use tricks to cover their tracks. Here's how they dodge detection, plus why tech makes it tougher to catch them. Shell companies and offshore accounts. Insiders hide trades behind fake companies or accounts in places like the Cayman Islands. These obscure who's really trading. Example, in 2018, a biotech exec funneled profits through a Panama shell company to dodge taxes and scrutiny. The SEC traced it, but it took years. Offshore accounts move money fast, and lax foreign laws shield identities. Tipper-Tippee schemes. Insiders don't always trade themselves, they tip others. A CEO might tell a friend, who tells a broker, who trades. Each layer muddies the trail. Example, Raj Rajaratnam's Galleon Group relied on a web of tippies, like Intel's Rajiv Goel, leaking secrets for cash or favors. The SEC needs to prove that Tipper got a personal benefit, which is tricky. Manipulating trade timing. Insiders space out trades or mix them with legit ones to blend in. They might trade just before news breaks, but in small batches, to avoid red flags. Example, in the 2009 SAC Capital case, traders staggered buys over weeks to mask their edge on Dell's earnings. Algorithms now flag odd patterns, but clever timing still slips through. Tech's role in hiding. Encrypted apps like Telegram or Signal make tips nearly untraceable. Unlike emails, these messages vanish or lack metadata. Example, in 2021, a hedge fund manager used Telegram to share MNPI about a merger. Investigators only caught him through an informant. Dark pool trading platforms, where trades are anonymous, also help insiders hide. Tech speeds up schemes and buries evidence. Global perspective. Insider trading often crosses borders. A trader in London might act on a tip from New York, executing trades through accounts in Hong Kong. Without international cooperation, catching these criminals becomes nearly impossible. Organizations like Boesky, International Organization of Securities Commissions, help coordinate efforts, but progress is slow. Some countries resist sharing information due to privacy concerns or political tensions. Let's have a look at how insider trading is handled in different parts of the world. United States. The U.S. is the most aggressive when it comes to enforcement. They have the SEC, the DE, wiretaps, sting operations. If you get caught, you risk years in federal prison. Rajaratnam, Martha Stewart, dozens more. The U.S. makes examples. Australia punches above its weight in enforcement. Thanks to ASIC, Australian Securities and Investments Commission. They use cutting-edge tech to monitor trades and aggressively pursue offenders. Example, In 2022, an Australian stockbroker was sentenced to 4 years in prison for insider trading linked to a pharmaceutical company's clinical trial results. The swift punishment sent a clear message to would-be cheaters. Europe, the EU's market abuse regulation, MACR, bans insider trading, with fines up to 5 million euros for individuals and 7 years in prison in countries like the UK. But enforcement varies. Germany and France crack down hard, while smaller nations lag. Example: in 2019, a Deutsche Bank trader was fined 1.5 million euros for trading on merger tips, but cross-border cases often stall due to bureaucracy. Europe's fragmented regulators struggle with global schemes, hurting investor confidence and market stability. Asia. In China, insider trading is rampant due to weak enforcement and Guangxi, relationship-based, business culture. The government is both the market regulator and a major investor. Some insiders have been jailed, others protected. It depends on who you are. Example: in 2020, a Shanghai exec made $10 million trading on merger leaks, fined $2 million, no prison. Japan has strong laws up to 7 years in jail, but cultural norms often protect corporate elites. Cases rarely make it to court unless the scandal is massive. Emerging markets, Wild West. In places like India or Nigeria, insider trading laws exist, but enforcement's weak. India's SEBI fined a Reliance Industries exec $1.3 million in 2021 for trading on earnings leaks. But convictions are rare. In Nigeria, laws are vague and penalties often under $50,000. Weak oversight lets insiders run wild, scaring off global investors and stunting local markets. U.S. Congress insider trading. The longest jail time sentenced in the USA for insider trading was 12 years, served by Matthew Kluger, a former lawyer, for his role in a 17-year insider trading scheme. For you and me, trading on secret information means jail time and massive fines. But what about U.S. Congress members, you ask? Well, the biggest jail time ever sentenced was 26 months for Christopher Collins in 2020 for participating in an insider trading scheme. He tipped his son about a failed drug trial of a company he was on the board of. And yet, in many cases, it was zero consequences. No jail, no charges, nothing. Is it legal for Congress? Technically, no. Before 2012, members of Congress weren't explicitly prohibited from trading on non-public information they learned through their official duties. Because of how insider trading laws were worded, it was unclear whether they applied to lawmakers in the same way they applied to corporate insiders. In 2012, Congress passed the Stock Act, Stop Trading on Congressional Knowledge Act, which explicitly made it illegal for members of Congress, their staff, and other federal employees to use non-public information for private profit, including stock trading. So insider trading is explicitly illegal for members of Congress. They're supposed to disclose trades over $1,000 within 45 days. Does it work? In 2021, Representative Tom Malinowski hid $671,000 to $2.76 million in trades for years, paid a $200 fine, and walked. Representative Byron Donalds failed to report $1.6 million in trades. Same story, no real consequences. But that was just for Stock Act violations, you say. So what about actual insider trading? This must be treated more seriously, right? Let's look at 3 examples. Representative Nancy Pelosi's husband, Paul Pelosi. Over the years, Paul Pelosi has made extremely profitable trades, especially in tech companies like NVIDIA, Microsoft, and Alphabet, sometimes right before Congress debated legislation that would impact those industries. In July 2022, for example, he bought a large number of NVIDIA shares right before a congressional vote on funding U.S. chip manufacturing. Outcome: no investigations, no charges. Nancy Pelosi has repeatedly denied any involvement in her husband's trades. Senator Richard Burr. In February 2020, just before the unspecified virus of unknown origin crashed the markets, Burr sold up to $1.7 million in stocks, shortly after receiving classified briefings about the virus. He was reassuring the public about the government's preparedness while privately dumping stocks. The timing was almost perfectly aligned with market peaks. The FBI investigated and even seized his phone. Outcome: in 2021, the Department of Justice closed the investigation without charging him. Representative Tom Price. Between 2012 and 2016, while serving in Congress, Price traded over $300,000 in healthcare stocks. At the same time, he was pushing or voting on legislation that directly affected those companies. For example, he bought stock in Zimmer Biomet, a medical device company. Just days later, he introduced legislation that would have benefited the company financially. He was buying and selling stocks in companies that stood to gain or lose based on bills he was personally involved in shaping or supporting. Outcome: Price was confirmed as HHS Secretary despite criticism and an ethics investigation. He later resigned over unrelated issues involving misuse of taxpayer money for travel, but was never charged for the stock trades. Insider trading doesn't just steal money, it robs us of faith in a fair market. Every tip, every shady deal chips away at the idea that hard work and honest bets can win. As long as insiders keep rigging the odds, the real cost is a system that punishes the many for the greed of a few. Stay sharp, because knowledge is the only edge we've got.